Hello. Welcome to In 180 Seconds. Today we shall go over some important terms to be aware of when you analyze the fundamentals of a stock. This fundamental analysis helps in understanding the company's position and valuation. You could then make a fair judgment on whether you should invest or not in a company. Alright. Let's first check what EPS mean. EPS stands for earnings per share. This metric tells the investor how much money in profit is each share of the company bringing to the table. So for example, the current share price of HDFC Bank is Rs 1,503. The current EPS for this stock is at Rs 57. Which means, each share of HDFC Bank is earning 57 rupees. How is this calculated? Here is the formula. If the company is making a profit amount of X, then if you divide this profit by the total number of HDFC Bank shares available in the market, that will be the earnings per share. Looking at the trend of EPS on quarterly or annual basis of a stock tells us if the company is running profitable or not and if the growth prospects are good. Alright. Let's check the next financial ratio called P, which stands for price to earnings ratio. This ratio is calculated by dividing the current market price of the share with the EPS, which we just learned. Looking at P ratio of one company with the other gives us an indication of how well a company is performing compared to its competitors. Generally, it is considered that a higher P ratio indicates the investors trust the company growth and tend to perform great in long term. A lower P means there is relatively lesser faith in the company's growth. However, it is sometimes tricky to read this P. You might find stocks that have lower P, but has a strong growth. Such stocks are actually underperforming to its actual potential. Or in other words, it is an undervalued stock. So someday when this stock comes to focus, its share price will be corrected and you will see a huge rise in its value. That's the reason, looking with plain sight on P ratio is not an easy way to come to a quick conclusion. It tells us more information than the number it presents to the naked eye. Comparing the P ratio of companies belonging to the same sector is an important part of fundamental analysis. Alright, let's understand book value of a company. Book value or BV, in its simplest form is nothing but the difference between the total assets minus total liabilities of a company. For example, a company ABC has a total assets valued at 200 crores. And the total liabilities stands at 150 crores. Then the book value of the company is 50 crores. So if a company shuts down all of a sudden, this is the net asset value the company can retain after settling the dues, and would be distributed to the investors post some mandatory payments. These values are listed in the company balance sheets and released quarterly or annual basis. If the book value is negative, it is considered bad and there are chances of the company going bankrupt. Alright. Now let's look at the last ratio for this video. Book value per share. Also called as BVPS. If you divide the book value by the current market price of the share, you get book value per share. This ratio indicates the net asset value of a company per share basis. So if you see the BVPS is higher for a company, then it is generally termed as an undervalued stock. In a way, it helps us find stocks that are available at a bargain to purchase from a long-term perspective. One last word before we close. Understanding these financial ratios is a must in doing fundamental analysis of the company's valuation. There are other important ratios as well, which we shall cover in future videos. We need to look at multiple ratios while doing the evaluation of a company. Thanks again for watching. Goodbye.